many investors were caught by surprise when President Cyril Ramaphosa signed into law the new National Credit Amendment Bill. Not only will it have a negative implication for banking stocks, but also for retail shares. For more on the implications, I'm joined by Mbuso Mbuli, who is the Senior Equity Analyst at Sentio, Hlelo Giyose's Chief Investment Officer at First Avenue Investment Management, and of course Wayne McCurrie from FNB Wealth and Investments is still with us. Thank you so much, and thank you to our new guests for joining us. This new Credit Act Amendment Bill, when it came out, the banking sector and the Banking Association, we saw a relatively negative response from them, given that they believe that the implications will be mostly negative. But then we have seen quite big declines in retail shares of late, and the question is, have these declines been related to this credit bill? Mbuso, perhaps you can kick off the conversation for us.
Sure. Well, if you look at the retailers, and especially the credit retailers, it ranges. At the high end, you have Truworths that derives 70% of their Truworths Africa retail sales from credits. And at the low end, you have Mr. Price, which derives about just under 20% of credit sales from consumers. And so there will be an impact just because it will mean that there will be an expansion of some of the debt that the consumers had accumulated over previous years. And going forward, so at inception, when it does come into effect, you'll most easily see it at an interest income level, because the retailers have provided for this. You do have an accounting standard that has come in, IFRS 9, and that means that you must provide for the credits that you've granted on a forward-looking basis. So one of the considerations would have been the amendment bill, and also just the state of the consumer as well. We've seen tremendous pressure that has come through from your administered prices point of view, as well as low job growth, and in some cases you've had some jobs being shed. And at the total exposure of these credit retailers, they do lend a lot to the low, mid and low income consumer. And as a consumer, your first entry into credit will be with a credit, with a retail credit, with a store card.
And also, I mean, it will also be the last thing that you're looking to pay off, or when you're looking to reduce debt. I know many people, maybe myself in the past, used to ignore those phone calls from your credit provider as to pay. But Mbuso, if you say that the retailers have already made provision for this, then it shouldn't be such a big deal in terms of the impact on the sector. Hlelo?
I think for the most part, actually not just made provisions for that, but written them off. Some of these debts are old, and some of the folks who aren't credit worthy now haven't come out to borrow money, to borrow to purchase goods. So a lot of these debts really won't have much of an impact on the profitability of these firms. But I'll tell you what is going to have an impact, or what is having an impact, is the architecture of the free enterprise system. The way that investors are looking at it is that the industry had done a really, really wonderful job of, both the banking industry and the retail industry, of extending credit to people that were previously unbanked and didn't have access to it. Not only to extend credit to them, but also to figure out how to repair that credit when folks fall foul of it. So you had debt consolidation, you had an ability to just work out nice and slowly payment terms with whoever you owed money. So the industry actually has mechanisms to work on not only lending you debt, but repairing you. And the folks that are left standing now that require this sort of help from the government are folks that, to a really large degree, have been irresponsible with their debt. Now the market is such that if you've been irresponsible with debt, you have to pay the consequences of that yourself, not for the government to step in and make it easier for you to continue an irresponsible habit. And so investors are looking at this and not understanding, or really, this dissonance being caused in investors' minds about what approach to a system of commerce is South Africa pursuing here, because this is not the correct approach, given what industry has been able to do on its own.
And I've seen that the thought actually quite extensively to say that, I mean, ultimately we're not fixing the one of the problems being, you know, the lack of financial education, and you write a debt off. I mean, I think it's after a year or so, I'll go sign up for more credit knowing that, you know, it will be written off. But then there's the other side of the argument to say it's not that consumers have been irresponsible about how they manage debt, but that these lenders have been reckless in how they disperse their lending.
Lenders are there to lend out money. That's what they do. They advertise, they push it, that's their job. They're there to lend out money. Obviously, if they lend out too much and get caught with bad debt, then they sit with that problem. But you must maybe we can go back a bit in history. In the 90s, the banking industry as a whole got into severe trouble with the government because they weren't lending out enough. Now you're in severe trouble with the government because you're lending out too much. Okay? And I agree with Hlelo. The interfering in the capitalistic system doesn't always give you the benefits that you want, and you quite often get unintended consequences arising from this. So let's look at this amendment bill. Now, we all know the NCA and the debt counselling and all of that stuff. We know that. Now, this says you can come to us, we'll work it all out, we'll write off your debt, but we write off your credit history as well. You go off the blacklist.
Making it harder for you to get credit in the future.
The problem is that you're never going to get credit ever again in your life from the formal sector if you go this process.
Maybe
so you will never get
a long time. Maybe for a long time.
No, probably never again.
Forever.
Probably never again. So what's going to happen? You still need credit. The need for credit doesn't disappear. Then you go to the loan shark industry. You know, so you've got to be careful. Look, the actual impact of this bill is relatively marginal. There's not that much physical amount of money caught up in this. And of course, it's not, you don't just sign a form and you get debt relief. There's actually quite a long process you have got to go through to get there. So it's not an automatic thing, you know. So you probably find a few people just won't even bother to go through the whole process of getting that, because they will understand that once you do this thing, there's no more credit for you.
Right. But ultimately, what does it mean for stock picks and also the future earnings of these retailers, a lot of them that have, you know, quite a high portion of their sales coming from debt? You did mention Truworths. So now you say that many of these companies have, you know, made provisions for this bill. So that's historic. But going into the future, how does this bill disturb their lending model, if it does in any way? And if so, I mean, who would be more impacted and who less so?
Going forward, it means that you don't have as big a pool because the companies will be more cautious. There's a portion of information that you don't have because consumers would have gone into this. And so retailers will be more cautious extending credit going forward. So you'll find, if you just look over the last couple of years, you've seen that credit balances have increased, but to existing customers. So companies are more comfortable lending to the people that they know and whom they've experienced, they've had a long relationship with and have experienced credits lending with. So you find that your overall portion of the market will shrink. And the extension of credit, which is one of the objectives of the NCA, will be now hampered going forward.
Because then, I mean, I'm just wondering, the thing is, the guys who can afford to pay for things with cash, you did mention the constraints that they're in. So in this environment, I'm wondering, going forward, would a player like Mr. Price, who relies less on credit for its sales, be able to better weather this new credit landscape?
Well, it's, you know, I mean, first of all, let's think about something. I mean, credit retailers have not been irresponsible. If you have not been, if you consider that.
Well, some might say that Lewis doesn't, at one stage, didn't fit that definition. But
here's some evidence. I mean, Truworths is the largest credit retailer, at least as a portion of their sales. Truworths has the best book, has the cleanest and the best book of all credit retailers, despite lending out more for credit sales than any other company in the industry. Woolworths actually has less of an exposure to it, also more diversified because they're part of their operations in Australia, so Woolworths is less affected by this, right? But when you think about what the impact is going to be and how you should invest, it's not this issue that's determining value and share prices. It is just the torrid state of the economy That's really what it just boils down to.
Sure.
And with the few good policies, things might be able to turn around. But you don't count on that, isn't it? You just continue to count on, a combination of, really, really good management companies, good operations, as well as valuation. That's what you count on.
All right. So, I mean, it seems that we are in agreement that this is quite a side issue for the overall valuation of these retail companies. So, I mean, given the fact that it's ultimately about the economy, your top picks for the retail sector, I'll ask you to go quickly.
On the credit retailers, I would go for Foschini Group.
Credit retailers.
Yeah,
retailers as a whole?
As a whole, I'll go for ShopRite, maybe Spar.
All right. Mbuso?
Some consensus there. I'd also go for Foschini's. They have the more diversified business model out of the credit retailers. And Spar as well. We also like that one.
Sure, I'd go for Truworths. Foschini is pretty good. I think
Truworths based on its credit book being cleaner.
Based on the quality of the business and quality of the credit book. Spar is pretty good. Pick and Pay is also pretty good.
All right. Thank you. We have reached the end of the show. Thanks once again to all my guests, Mbuso Mbuli, who is the Senior Equity Analyst at Sentio, Hlelo Giyose, Chief Investment Officer at First Avenue Investment Management, and also Wayne McCurrie from FNB Wealth and Investments for their input in tonight's program. Remember to email your questions to portfoliowatch@abn360.com and tweet at CNBC Africa using #PortfolioWatch. From myself, Fifi Peters, it's bye for now.